None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. We are live. Yeah, we're trying to take this real serious. We're right on time, I think within probably 10 seconds of getting going when we're supposed to get going. Notice I have brilliant orange on today. Mitch has his white shirt on. He got rid of the sweater, so we're making progress, but not very much.
We're getting there.
But not very much progress. Anyway, crazy stuff going on. Can't get 2 days in the same direction of the market. 2 days ago, the market looked like it was going to bust through the highs and go challenge the all-time record. And what do we get? Down 12. Now, what do we get today? The reverse. So we're back and forth. It's, man, it's getting to me. I don't know. I can't handle it much longer. We need to break out of this range, and it's a tight one at that. So notice that we are down on our new location at the New York Stock Exchange. We are now down by Tiffany's, which is one of our featured stocks for today. So we'll be talking about that a little bit later. But yeah, so we're, I'm hoping when we go through the charts we can figure out something. I thought last night when I was going to do commentary, I thought, aha, this is it. Well, woke up this morning to find the futures up big, and it's not it. We're right back. Matter of fact, the headline again and again and again, I guess that was pretty appropriate because that's exactly what's going on. I don't know, Mitch, you see anything overnight that caught your eye?
Not really. I mean, it's paint drying right now.
Yeah.
Watching grass grow.
Yep. Yeah, I didn't see anything either. I went through some news, and other than I guess Obama covering up another scandal with the VA. Everybody's going to be held accountable, just like Syria. I'm sorry, that was off the cuff, but it's just frustrating to see what's going on sometimes in this country. Anyway, so let's go ahead and we'll keep Mitch up on the screen here for a minute, I believe. Let's go, and I'm gonna switch over to. Hang on a second here. I will get us over here real quick. So here we go. So got some live markets going on. I set up a couple new screens here, but we'll start at this one for the moment. And in fact, I think I'm going to get Mitch out of the way because he's right in the way there. And I've moved myself over just a little bit here. I'm not sure if that's appropriate or not, but looking at this market, the way that it continues to trade, it's difficult to actually see anything different than what we've been seeing here. And I tried to move myself over a little bit so I can get out of the way of some of this stuff. But the charts are continuing to be pretty much as they have been. Yeah, I was wondering why I couldn't see. I guess you got to put your glasses on. It's not easy getting old, I can tell you that. But the ranges and everything that we keep seeing is more of the same. The moderation of the Fibonacci objectives that I've been talking about over the last several days continues to be, you know, for me one of the primary things that is obvious, if there is a such thing right now. They put a couple arrows over here. These Fibonacci objectives are now have been moderated once again to a objective of 1900.51, so just a touch over 1900 to 1916. So because of this tight range we've been in, we continue to see this consolidation, and it's getting tighter and tighter. So I don't know if it's going to explode out of this, or if it, if you look at this chart here, I'm going to draw another line. This is pretty amazing, actually. We're a little bit on either side of that line. I bet if I figured out what the high, low, and what the medium is of that range that we've been in, this goes all the way back, by the way, to March, roughly March 24th. That's what we've been doing for a good part of the year. Mitch made a comment yesterday that, boy, no one wants to do anything since this year started. Here we are in May, and we're up 1%, to flat. There's just nothing out there that anybody wants to participate in, and it makes it, I don't know what it makes. It makes it really, really frustrating. So, not a lot's going on. We've talked about over the past the database, the VPM database is continuing to see a contraction. And on Monday, Market Thunder, we talked about the sectors that are changing. We're down to only 2 sectors that are showing a trending indication right now. Matter of fact, I'll bring up VPM. I'm not even sure which 2 they are. But the groups have also dropped down. I think the sectors right now are 25% of sectors are long, and 35% of the groups, and about 47% of the individual stocks. Which, in that calculation, you end up with. I guess there's mutual funds. There's other things in that calc, isn't there, Mitch? I think.
Yeah.
Yeah. So it's not just pure stocks on that percentage, but it really encompasses other elements within the database.
Yeah, we sold out of capital goods and transportation this week. We're still long about 25% of the sectors, which is energy, technology, and utilities.
Oh, there you go.
So it's not much that we're holding on to at this point.
Yeah, that's what can you say?
Yeah.
So, what does all this mean? I think I can't recall, and maybe because the markets have been so volatile over the last 4 or 5 years, I can't recall a period of time like this. Other than I used to run a service called the Daily Quant Fixed Income Report, which was just for fixed income, and it was just for banking institutions. I ran that back from 1994 through 98, and I remember it was probably maybe 98, and the bond market went, talk about flatline. It just wasn't, it was acting very similar to what's going on right now. There was just nothing to talk about. The report, it was like I could almost just take yesterday's report and print it again for today, and not even worry about updating it much. So maybe this is a similar sector. I didn't read the story. I saw the headline. Was Al Iron, the former, whatever you want to call him, PIMCO, I think, and now he's at Allianz, I guess, and just trying to get away from Bill Gross. Donald Duck, I always call him. He sounds like Daffy Duck or something when he talks. But he was saying something about, the whole, what the bond market, that's the big debate, is the bond market right or not. We'll look at some of these things as a review, but there's really not a lot that you can put a handle on right now and do. I'm drastically searching for my cursor. I know why it's gone.
One of the other headlines that came out last night was, the revealing the fact that the insurance companies now have some extra bailout or some earmarks, if you will, in the event that the Affordable Care Act doesn't turn out to be as profitable for these companies as they originally expected. So I wonder what that's going to do to those sectors of the market when it comes to the insurance side of things.
Yeah.
That's something we'll have to take a look at.
And healthcare was a good sector while all this stuff was going on. It was
Right.
it's been pretty good actually. Yeah, I don't know if it's because we're sharing this thing, but it's not wanting to change the increment of time. So I can't figure out exactly what's causing that. But let's go over to look at it. That's really interesting because for some reason this thing is not updating because it's not showing today's price movement here. That's really strange. That's what's happening across the board here. So I'm gonna take put Mitch and I on the screen here just for a minute while I mess with the software. I'm gonna log out and then log back in, I think, and that might be helpful. Anyway, I think I guess from the standpoint of what's going on in the world, there just doesn't seem to be. I think the reason why it wasn't updating because I hadn't logged on, so that might help. Okay.
That would help.
Yeah. All the details. So it's coming up again now. So I'll go back to our favorite screen here. But yeah, the patterns that are unfolding here now it's going to look a little better. There we go. Usually review all of the PPMs on the index, and I know I'm in the way here, so I'm going to get just so it's pure chart here for a minute, and we're looking at the daily ppm 1 0.01, ppm 2 0.0034, and ppm 3 as 0.02. So they are reflecting exactly what's going on here. Is a complete flat market. So let's see if things will update now. Let's try to go to the weekly graph, and yay, it worked. So that's good. Same old, but the ppm 1 is now improved to 0.21 after today's 0.5% gain here. And we're already starting to fade. We'll look at some of the short-term stuff here. We're ready because I saw some things I was looking at before the show started that was sort of interesting. From the standpoint of this, we're 0.21 on the 10 weekly 10 or the ppm 1, and that was 0.17, so that's actually improved. 0.25, recall, if you remember, is the minimum trend level that you need to have. So we're getting back close on a weekly level or intermediate level of getting there. 0.10 on the ppm 2, that was that's actually down a little bit because it was like 0.12 the other day, and then the ppm 3 is 0.031, which is flat, but it's actually improving. So not a lot there from a trend standpoint. But let's go to last but not least, the monthly. This is actually becoming somewhat interesting. This is what I've been talking about for a while, and I guess while we've been looking for a let's see, I'm going to come back on screen here. Well, I've been looking for a some sort of top here. The sky isn't falling yet, but it does appear to be getting closer and closer. But as I've said, looking at this chart, we're starting to see momentum fade a little bit, but we have ppm 1, 2, and 3, 110, 138, and 1% exactly. And what that tells me is that we're still in this uptrend, and there's not any real possibilities of a major decline at the moment. When ppm 1 gets down below probably 0.40, even though it's in trend mode, that will tell us we're probably going to get down and test that area. Let's take a look and see if I can bring that up. I hope. Where's my data? There it is. But that number is 1800.48. That's been creeping up as the weeks go by. It was around 1897 not that long ago. Let's see here. We can see exactly what it was. It was 1780 on 430, and that was last week. And we go back a week before that, 1753. So next week we're looking at 1820 roughly at the current rate of change is where the 10-week moving average is going to be. So sometimes when you're doing analysis, you have to be able to anticipate to some degree what that is. And the from the standpoint of what you're seeing on here, it's really just the continuation of the trend that is there. And that's pretty much all that you get from looking at these longer term trends. You're not really actually going to get any sort of, I guess, indication on a short term basis or any kind of turn to go from that level at that time. So from the standpoint of the weekly and the monthly combining each other, they're both somewhat an uptrend. This has been the same story over and over and over and over. Is we've got a short-term uptrend and longer-term uptrend. I'm sorry, I'm going to try that again. Intermediate uptrend, long-term uptrend, and then the short-term based on the daily charts are as flat as you can get. So the paint continues to dry. Let's just look. I'm going to go to not this one. That's too short-term. Let's go and take a look at. We just had a cycle come in the last 15 minutes here. This is the 5-minute chart, and it's also the 24-hour futures chart. And we're just seeing this thing continue through this cycle as we see it moving up steadily. And then as we came in right before the opening today, I'm not sure, was there some news that triggered it, Mitch? Did you see any news out there?
Not that I've seen.
Triggered the rally. Because all of a sudden we were at 73 and we went to 81, this is a 5-minute graph, so we're looking at I don't know, 20 minutes, and it was right coming into the open. All of a sudden everybody wanted to own the market as we came into the open, and now we're seeing it fade off. If we go and look at the hourly graph here on the same chart, you can see we're starting to form another veil over the top, and usually when that happens, the market does not go higher. So we'll see over the next few hours how that works. There was a cycle that came in right here. Double click that. Sorry. A cycle that came in right here, right at the high, and that would suggest that was probably the top end of the cycle. And this rotates. It's about 23 hours actually. So every day, somewhat around the opening. After the opening, there tends to be this cycle that comes in. Sometimes it's a low cycle, sometimes it's a high cycle. One of the things, just bring up the whiteboard real quick, that I think is at least interesting of note. These cycle, I'm going to draw these. The ones that tend to be more substantial, you'll get this swing index, which is an index that this is a proprietary index that I developed way back in, oh my gosh, I guess 1991 or something. So you can see these cycles. We did not get as deep as a spike down at these lower levels. I just drew a line. We did not get a spike down there. So this particular doesn't really signal that there's a major low here. More than likely, it's the opposite, where there's still at least another try to the downside. But it looks like for the most part. Matter of fact, I should just write the commentary every day, and I'll just put, if yesterday was down, I'll say today will be up. I'll be like Guru or Swami, I guess. But it's just been, this pattern is what it is. Let's take a look at, as we continue review, let's try to find something interesting here. And as the great debate continues, let me just see if I can get, I put this, here we go. So what I want to do is I want to bring up the treasuries to start, and then we've got a couple of features we'll do once we get into the stocks of the day and other elements. And I'll even talk, we'll take a look and see how my favorite currency trade is doing. So let's go to look at the 10-year here. 253, almost 254. So we're seeing a bit of an increase. In my opinion, this thing is starting to stabilize, and it's going to be, as I talked about on Monday's show, there is going to be a definite, this consolidation, I believe the next phase will be higher yields, and we'll start sometime in the next couple, I don't know, 6-8 weeks. Once we get through the cycle, that's going to trigger this thing to go back above. Probably, I can run a couple numbers here. We'll take a look at it, what we've got here. Matter of fact, let's just do that. Let's go in and let's do some Fibonacci retracements here. And I believe that the calculation is going to be, this is hard to read for me, so I'll get a little closer here. This is going to be, yeah, so the numbers on the upside are going to be around 267 to 275 is going to be the point where you start to get into a trigger point. The extreme right now is 286. So we can stay within those ranges, and this market's going to stay neutral. Above that, probably 286 level, you're going to start to see a challenge. The highs that we made several months ago was back at 303. So that seems to be the most interesting thing that everybody's talking about right now. And there's not a lot of difference, so I'm not going to go through some of the intermediate styles. So let's go ahead and take a look at, let's see here. I think it's FXY is the ETF for the yen. I continue to feature this down a little bit today, but this is a pretty good pattern that looks like, if you look at this. Matter of fact, I would compare this pattern to Netflix. Actually, you had the rally off the low, and then you went down and kind of rolled off the bottom, and then the next event was Netflix going up and making a new high. And anyway, this, I think there's an absolute explosion going in there. So nothing else, if you guys do anything for your own personal account, this is something to do. And you can help me out. I need some more buyers. Anyway, but the currencies are, I guess, the other play. Let's take a look at the Dow index real quick. And now that, as I talked about on Monday's meeting, the Dow index is a basket, and it's a weighted basket. So it's like the S&P. It's got, the euro's the heaviest weighting, and then you've got a blend of, I think there's 12 or 14 different currencies that are weighted within this index. So you start to dilute what the possibilities are. This thing is also a flat line for, matter of fact, I'll try to run this, making a note here on this, but I want to make sure, I want to see what the median price range has been for 1 year, 2 year, and then maybe on the same with the S&P. We'll look at this last 6-week period, and typically what you'll get is the midpoint of that range will be the pivot point, and it looks like the Dow has just been in one of these same stable ranges. So while a lot of people are trying to talk it down, and I've read some commentaries and seen some things out there, you'd think the bottom was falling out, and it doesn't look that way to me. It looks more like a long consolidation. I'm not sure what will make it go up or down at this phase, but certainly it's going to go down versus the yen for sure, and some of these specialized currencies. Yeah, I don't know of anything else that stands out. We could go here, Swiss franc. I'm not sure what model I have on here right now. The Swiss franc just exited, but you can see some appreciate there. The actually big trade, I guess the big mistrade, since I wasn't really focused on this and we didn't have the show going, is the British pound has just been an awesome trade. You can see it here. Let me blow that up a little bit. But it's just been a wonderful trade from the standpoint of you know, of how this thing has been trending up. It's done quite well. And I can see I need to update this chart so you can read the numbers, because I can't read them here live, and I'm sure on the screen what I'm seeing on the production side is not doing a very good job either. But but you can see the overall trend. We've got some nice moving averages. The PPMs are really moderate. They've faded a lot. There was more robust, but this is a mistrade. But this type of thing, I expect to see even a sharper rally. Let's take a look at this. I'm going to spread it out just a little bit, and you'll see that it's been flat, similar to what the dollar's done, and you see it start to move out of that range. So it's very possible that this will be that if we think about the dollar index, going back over there real quick. What's going to cause the dollar to get stronger? Probably only one thing's going to drive it. We're back on the dollar index now on the screen. The thing that's going to drive it is actually higher interest rates. The interest rate differential needs to change. There needs to be something for international players to look at to make us maybe the carry trade or something. We'll see how that all goes down. But the bottom line is this looks like a similar pattern, not exactly the same, but ultimately, when you get these long consolidations, you tend to move out of this range. It won't take much to kick this thing back into a buy from here. We've had a couple over the last several years. We've had a couple buys, and you can see coming out of 09 was a big decline, but there was a really nice trade in early 10 in the Dow. Not significant, but I think it was about a 15 or 18% gain on this particular index. But yeah, so one of the things I've always done my best to try to figure out is looking at different markets, looking at them from a technical viewpoint, and then saying, okay, what would make that happen? And so what would make the dollar increase? What would make that all happen? And pretty much the only thing that's going to drive that right now, as far as out there, the U.S. economy is really the flat and I guess 2% growth. Actually, we were 0.01. There were people out there yelling that we're going to go into recession. So the next quarterly GDP was negative. They would start really screaming that out. But right now, the U.S. economy is actually doing better than most economies across the planet. So, with the exception of China, but we're not actually sure what China's doing, are we? We don't know that what's real and what's Memorex. They've got all these shadow cities and all that. And those of you that were at the 2010 National Conference, we had a guy named Hugh Hendry who went over and visited China and took cameras, and there was a bunch of YouTube videos of all these empty buildings. I actually was reaching out to Hugh last evening and going to try to get him to come on and do a show and see if he would come on. I don't know if I can get him. He's been hiding from media, but this is a closed media for a while. But he's a very interesting guy. He kind of capitulated about 3 or 4 months ago that now he's a trend follower right as the market's hitting the highs. He's always been a contrarian. But the overall scene that's happening here, currencies are probably, I've been looking for something to do in the markets because the market itself is not giving me a lot. And, from a standpoint of VPM's portfolios on an indexing basis, all that, we're really looking at, like we've talked about, we kind of beat it, about 57 to about 64 is the range. I think 57 is the average. It might be a little lower on some strategies as far as a percent invested. Let's go and start covering some of these other stocks. Let's see here. So Mitch and I'll come up here and let's go back. Well, since we're about to talk about Tiffany's, we'll go back down in our location on the New York Stock Exchange. That's a nice monitor you have there, Mitch. Big monitor
Yeah.
in front of you.
Wouldn't mind that right now.
Yeah. But I think in this segment today, there's a number of things we've had. We've had a couple requests that that folks have asked for us to talk about. So please, 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 other than commenting about Mitch's sweater or his shirt, send us some other things. He's kind of fun to bust the chops a little bit on some stuff. So we have a good time. So let's go ahead, and I guess we must start off. Let me go over to, let's see, we're going to go just to a screen here with just the market. And what is Tiffany's symbol?
TIF.
That's right. And what model are we to have on this?
The optimized trade system is 1.2.
You know what? I have a better. Hang on a second here. Thought I had a better. Yeah. That better? Yeah, I want to get a better screen here. This will be a better place to go. So let me try TIF here. I believe this will be easier to read. You got bigger numbers and all that. And you said what number? I'm sorry, 1.2?
Yes, sir.
Okay. That's what's on. So we are flat this thing, right?
Correct. Yeah, they released earnings today, so they have a nice pop today. On the 3.2 system, we are along that. I did see.
Okay. And that probably goes back from almost the original 1-2 position, I suspect.
You got it.
Yeah.
Yep.
Yeah, a lot of times, matter of fact, that's something Mitch thought would be good to talk about, and maybe we can utilize Tiffany's to do this, but actually talk about some of the differentiation between 1-2 and 3-2. This might be a good time to talk about that, and then we go use Tiffany's to drill down and take a look at this. So this is a weekly chart at Tiffany's. We currently have no position. If you did have 3-2 on it, but we'll talk about this. So wish I had. I'm trying to think if I have a screen available. Probably not on this computer to actually feature that a little better. But one of the things that, from a modeling standpoint, that VPM has, I'll bring this up while we're talking about this real quick. So, but one of the things that we have in the models is the 1.2 version tends to be a little more aggressive. It lacks one of the filters that 3.2 has, and that is there's actually a fourth ppm that comes involved in ppm 3.2, which is ppm 4, which is actually tied to an 89-week or 89-day period moving average. So the ppms, just to review that, is that they measure the percent change of a moving average, which gives ppm stands for price pressure momentum. So instead of looking at the closing price as momentum, I look at the underlying moving average to determine trend. And I've talked, we've talked a lot about this ppm 0.25. Well, that is the minimum that gives you about a 60 to 70% probability that the market will not decline below that value, and if it does, it usually won't close below the value depending on the increment of time. So if it's a weekly graph, it could spike below that level, but tends to close back above it by the end of the week. And the same thing on a daily. If you have a daily 0.25 or greater on a moving average, if it hits that, it'll usually touch off. And there's quite a few set of rules that were built back in, I guess, in between 1983 and 86, where a lot of work was done then on determining these trends. So it was long ago. I realized that that's nearly 30 years ago.
It's a while ago.
Yeah, I was talking to somebody yesterday, and I was telling a story, and I realized, oh my gosh, that was 30 years ago. So, anyway, I was a much younger man then. But the difference, primary difference on this filter, this is 1.2, and this would be a good contrast. You can see the number of trades across the screen just as you look at it. When I put this over to 3.2, 3.2 has about 30%, roughly, this is an approximate number, about 30% fewer trades than 1.2 has. And in that, because of the longer term average, the 89 period moving average that I talked about, and the PPM4 that's on there, that gives the market ability to handle more noise. So when we're modeling these things, and you're looking at 18,400 stocks in our database, we are actually, we're, I think 4 days or something from optimizing the database. We have to watch, make sure, just see if there's any real shifts. I don't expect any material shifts, but we look at what the best total net profit is for each one of these models, and then when you go into research, it's going to map out to the best model. And there's a couple trades that have happened. Probably it's very potentially that Netflix will switch from 1.2 to 3.2 with this most recent update. But the difference between the two is 1.2 is more aggressive, doesn't have that longer term filter. 3.2 is more tolerant of the noise. So let's go in, and I'm going to switch this thing from 1.2 to 3.2. Now you're going to see the difference. This 3.2 trade has been on for a very long time, and this, let me just bring up the whiteboard here. This will make it easier. But you can see 3.2 has been long since way back here. Now roughly in April of last year, and look how this trend's been trading. It's just been stair-stepping pretty much right along the moving averages, and it's been holding those moving averages. And remember, this 3.2 model has actually a the 89 period moving average, which is looking at the really long moving average trend, and this trend has been pretty dominant from the standpoint of what's been going on here. So not only in this case, I mean, there were buys and sells along this staggered line. I'll bring it back up so you can contrast. So 1.2 is when certain elements are broken, it's going to get out to protect. 3.2 is looking at things better. I'm surprised, at least this last trade has been much better. I'm sure if we could, matter of fact, why don't we do that? Let's bring it up in VPM here. Get to research, and let's just take a look at what that difference is. So here's TIFF. I'm going to make this a little bigger. I'm going to attempt to anyway. And yeah, and as a matter of fact, I'm going to get rid of Mitch and I because we're just getting in the way here.
Yeah.
So you can see here, as it was going up, there's a couple pretty good trades here from the standpoint of this trade down here. Let me whiteboard this thing. This trade right here, you can see is, can't find my cursor, it's floating around on me, there it is. This trade right here was a decent trade. It made it here, and then we got another. This is really weird. Okay, sorry about all the lines. Then we got a buy here and then a sell over here, which was the last trade on that model. And we'll look at the stream here and just see what it was from the standpoint of. Let me just look at the model overview page so we can see what the stats are on this particular one.
Yeah, one of the reasons why I did want to grab this is I thought this was a great example of how on this particular stock, the 1.2 got in quite a bit earlier on this uptrend, but it didn't hold it all the way up. So it originally purchased it, as we'll see here, back in September of 2012, excuse me. And whereas the 3.2, which I'm sure we'll take a look at in a second, didn't buy it until February of last year. So the 1.2 did get in earlier, but it also got out earlier on the trade.
So let's talk about that. That's interesting because let me get my whiteboard back up. So why my cursor's not showing up? It's really look at that. That's nice. Okay, at least I can get rid of that. So the lows and the highs here, this differential, that's the hindsight total 100% of the trend. And if you look at where, I got to draw arrows from over, this is nuts. If you look from where it bought and then where it sold on this, nice, where it sold up here, you captured, I'm going to guess about 40 or 50% of that, and then the trend, it got in and got out again. So it trying to capture, the goal is always to try to capture 60 to 80% of these trends. So it captured the easy part. The next part got a little more volatile, and this thing started to swing in a pretty wide range from what looks like about 92 down to about 80. So, that's about what, a 10% swing on this stock. And so it spiked down. So when it spiked down, then all the trends, and if we go down and just take a look at these PPMs here, you can see they all broke down, and there's not any uptrend at the moment from that viewpoint. But now we're going to go over and switch this to 3.2, and you'll see a much more tolerant model for this particular piece. So hang on here. So our current trade is up 47.73%. And maybe you can see it. I realized somebody that a certain percentage of men are colorblind. And I had an advisor on one day, and I was trying to show him where the buy was, and he couldn't see the green little dot there. So contemplated just making them all black, but then anyway, it's one of those things. But there are some of you that have trouble with that, and the trade is still long here, so it's able to take this noise in this model and tolerate it. And then today with it being up 8.5% after earnings, it's still participating in there. So depending on what we don't know is where this particular model gets out. It's got a 149. Matter of fact, let me make this a little smaller so we can get back to the page. Let's take a look at the overview, because I think this will probably be the most reviewing. We've got a total net profit of 294 on 3.2, and I'm going to switch this over to 1.2 here. And 1.2 has 465%. So one of the contrasts when you're utilizing these models is to understand that while there may be more trades, the profitability can be huge. Even though you're in and out, and sometimes you bought it and sold it, bought it higher, all that kind of stuff. In the end, this thing doubled what the 3.2 output is. Even though the last trade looks like, boy, this thing's doing a lot better job, it really isn't. And you're better off getting in and out, and participating in those shorter term trends. And we didn't really look at the trade profile, but let's do that real quick, and then we'll move on to some other stocks, because this is, I guess, an ongoing question from the standpoint of what.
Well, on that note, while in this case the additional activity has generated more net profit, we have seen some advisors lean more towards the daily side because they think, well, I want to go with the daily because it's more active. It's therefore going to get me in sooner and out sooner of a trade when it starts to turn, or either to the positive or the negative. And one of the things that I've cautioned as well is, when you go to select a trade system on a security, in the event that you want to consider a daily, you really need to take a look at the number of trades as well as that net profit. Because it may be that the net profit is slightly higher on the daily systems, but the number of trades to get there is exorbitantly higher, maybe 2 or 3 times, if not more, than what you would see on a weekly trade. So it adds additional complexity in the actual execution of the trades, but you're also doing a lot more work to not get any additional returns out of it.
Yeah, and it's, I guess comes down to this transactional environment as well that we're in. It's funny, we live in a fee-based world, but all of the custodians charge on a per trade. They're still in a trade-by-trade transactional model.
Right.
So there's a conflict all the time between the fees and the custodian. There are custodians out there like Pershing and some other, I think Fidelity has them, they have some flat fee.
Yep,
They
TD Ameritrade's doing that now too. It's slowly changing.
Yeah, and that's helpful because on a transaction basis, per transaction basis, when we're doing rebalancing trades and all that, and especially my biggest frustration has been, unless you're big enough or you have a prime brokerage type relationship, these guys charge for every ticket instead of maybe you'd be better off with a per share type arrangement rather than a per ticket. And these tickets add up. Not only for instance, you put a batch order in a bulk order for 30,000 shares, and it's on 173 accounts. They're going to give you 173 ticket charges.
Right.
Which is, instead, really what it was one transaction for 30,000 should be one ticket charge, and then maybe some kind of administrative fee to allocate those trades out. But that's not how it works. And I keep arguing the broker dealer that figures that out will get all the business. But in the same respect, the other way to do it is just a flat fee, so those transactions don't come into play. So that is actually the answer. So I would look in, if you folks have look at your platforms and see if you have the ability to get on something like that. It will make it a lot easier. And I guess the other mistake we see advisors happen all the time is they're passing the tickets through to their clients, and that just causes frustration. And the nice thing is, if you pay for them, you'll really understand what the cost of it is and some of the frustration and how to deal with that. And we always have, we always suggest that you do it that way so that you can actually, so you don't have to pass through tickets, but you also reprice your fees to make sure you're absorbing the amount. Because the nice thing about if you stick with VPM and do that, utilize all the elements that it has there, you're going to have a reasonably predictable trade flow that you can figure out what the cost is going to be. And so anyway,
that's a good advertisement for tomorrow's process work.
It is.
That's exactly what we're going to be talking about.
I know.
We're
going through, I don't know if we'll get through PDC tool, but we're going through the
cost
calculator, the cost calc, and some other things, because when you come down to running everything in a practice, that's where it goes. So I'm sorry to get on that tangent, but let's go to another stock here. Let me go back over real quick before I do that. I don't think I looked. Yeah, we did do that. Okay, I'm all right. Okay, so let's go on to another stock here.
Next stock is MA for MasterCard. That is also on the 1.2 system.
I think I switched over to 3.2, so let me do that real quick. And we are flat at, right?
Correct.
Okay. A couple things I have on this page here. Let's talk PPM talk for a minute. Man, I really need to make these bigger. Hang on a second. Trying to find this one page that gives me a better view. I guess that's it. Here it is. Let me get the right stock on here now. That's on there. Okay, it is the right screen. I was on it. Couldn't tell. But look at the PPMs. You see that all three of the PPMs, well, actually two of the BPMs, the longer term, the 21 and 40 have been under pressure and have moved down a lot. You're looking at 0.45 is actually up on the PPM 3. Minus 0.4 is the case for the 21, and then you've got a minus 1.6 on the 10, but it's actually starting to pick up. You can see it's ticking up here. So from what's going on here, this is probably a classic consolidation. There may be one more high on this stock, and one of our original users of this software always used to say something. I'm looking at it here. Stock doubles, and it usually will double again, and that's it. So if you look at it going from like 30-ish to 60, then that's a 120 price. That seems a little out of line, but after that, what's happened is this stock has been on a roll here for some time, and that is there was a nice trade here because we had purchased this thing at $47 back on October 12, 2012. Then we sold out of it at $73.86 on April 4th, 2014. And this is one of the things that I've talked about before on previous shows, is a lot of the selling that we've seen come into VPM over the last couple months have been trades like this where we've taken some long-term profits. There's a ton of these, literally thousands of them that have occurred, and we had 4,000, 5,000 exits, not that many. In April we saw a lot of turnover in the database, and that is actually because of trades like this. And they're okay because we took long-term profits. We're looking at, what I think 43 to 73 roughly. That's a pretty good sized trade. And a lot of these trades have happened. We even saw indices that have been long from the same period, that last quarter, even last quarter of 2012 or first quarter of 13, where this market's been going up for a year plus. And typical cycles on what we see there is about 18 to 24 months. So we're getting very mature on every possible level you can imagine. So let's move on to our next stock.
Well, and one note on that,
yeah.
We had talked earlier about the sectors that we were still long. Two of those sectors we are either at or past the duration, the average duration on that. So energy, we're past the duration on it, and we are almost exactly at the duration on technology as well. So it fits right in line with what you just said as far as getting to a point where we're at the very late stages of this mature market.
Yeah, I just brought that up on the screen. Of course, I'm right in the way, so I'm going to slide this thing over just so we can see some of these numbers. But here you are, what you're talking about. The average holding is it's 348 of 222.
Yeah.
It's pretty overdone there. And then on technology, as you said, 220 of 218. So we are right on the money on the technology. And then the last utilities is pretty new, 46. But guess what? The utilities is interesting enough. That's that's really an interest rate play, but it's also a defensive play.
Right.
So, but everything else you can see down here below. As I toggle down, you're going to see that this is completely flat. And we had two cells: capital goods and transportation. And I'm going to pop up that chart real quick here. See if we can take. Oh, I hate when it does that. Hang on. I hate the Windows Auto. If you go too high up, it redoes it here. But let me scale this back just a little bit. So once again, you can see this trend. If you go from 2009 forward, matter of fact, maybe that was a good idea to do it full screen here. And I'll make it a little bit, that's a little big there. There we go. So you can see all the way from 2009, this thing has really, this index has been on a tear, and it pretty much mimics what we see in the indexes, but you're looking at this stair-stepping pattern. And I'd have to argue that looking at this, even though maybe we're going into some kind of neutral mode here, that you could see a pattern that sets up like this, and maybe there's more down the road. Typically, this would be considered as a 1, 2, 3 pattern, which would suggest that we're really, there should be a fourth wave consolidation, and the market should maybe make one more new high. And it doesn't have to go into configuration I just said. It could be consolidation, go down to the 40, spend a few weeks there, one more shot, a new spike high, and then the pattern's over. Every pattern that I've been looking at, and as we go, actually this show gives an opportunity for you folks to kind of go through the analysis with us. Every pattern out there looks like this. So it's just a matter of, when you see a chart up here, what we're talking 5 years up, sooner or later you're going to get you're going to get a top, and when that top happens, it's 5 years up, probably looking at a year or two of defensive type action that is likely to occur. As go ahead.
Yeah, can you pull up the technology chart, because you'll notice that looks very similar to what you just pulled up in the capital goods. Same type of activity where we've been working this trade for the last 5 years, and you can see that not only have we pretty much hit the duration side of things, you could also see how the market is really just sort of flattened off at this point. So it's not necessarily that we're going to be selling out of it right now at this level, but you could see that we not only have we hit it on the duration side, but you could see how the patterns are beginning to taper off on it.
Yeah, and this is my favorite pattern. I call it the soft rollover, where it just goes up, got great momentum, and then it starts to roll over, and we get out of this thing. And this particular capture, even if it made a new high, let's say we got out and made a new high, and we probably wouldn't get back in, because VPM doesn't like that last leg up. It's too dangerous, because it's usually the climactic move. But we're going to, I can pretty much, here I go with, now we're going from promises to guarantees. I had a nickname when I was on the trading floor. They called me Dr. Given. And I would always say, oh, it's a given. It's going here, it's going there. And it was based on all the analysis that we're talking about now. I've been doing the same thing for more years than I'd like to admit. But it works, so that's all that counts. But this is one of those patterns that it's going to roll over. We're going to get out of this pattern. Maybe there's a new high, but in the end, if you look at it, I bet we capture anywhere from 70 to 80+% of this trend because of the way that it's ending. These soft rollovers are awesome. And what's happening, even just to kind of some closing comments here, let's say we'll go back down to Tiffany's, because I think that's about all we're going to go back down to the stock exchange and finish the show here. But when you're getting into these type of places and the trend, it is absolutely, this is just like classic stuff. So if we get the soft rollover and then we go into a corrective phase, I don't know if we'll go down 10, 20%, 5%. We stay in this crazy range for the entire summer and come out of it next fall. I don't know how it plays out. But for sure what's going to play out is about 80% of all of the trades that we're getting out of are long-term profits. So tax efficiency is really good in these type of patterns. They happen that way. It's interesting. 2003 to 4, soft rollover in 04, market in 04, 5 was just flat. They were like 3% years where we spent years, I guess, maybe discussing this. I realized that we've done this before, of these crazy just sideways markets, nowhere going. And not only that, 4 and 5 were terrible. 6 finally saw a little better year. That was one of the years that we saw the death pattern where the market's making new highs, but fewer stocks were participating. Of course, we in 2007 that stayed on. Of course, we know about the end at the highs in 07 and 08. We're going through that same pattern again. It's the same thing we did 2003 to 4. We did it from 2009 to 10. We had a soft roll. We did pretty good. we had some volatility due to crazy ideas about Europe collapsing and every country. I don't know what was going to happen there, but the scenarios were the end of the world again. We got out of that. Now we're back into this nice big rally. Everything's okay. Now we're coming into that phase again that this thing is going to roll over. And in a way, I wish it'd just do it today or tomorrow, but it's going to do it when it's supposed to do it. And right now isn't the time. There's, like I said, on the longer term aspects, there's still a long-term trends underlying. So this is going to complete our show for today. Maybe real quick, maybe 30 seconds. We're right at the. We're actually running over a minute today, so we'll go ahead and finish it off. But Process Warriors tomorrow, we're going to go over a lot of aspects of implementing and cost, understanding cost and other things. Mitch, you got anything to talk about on the show tomorrow?
No, just that we spent some time building portfolios, talking about how to maintain it. Now we're going to show you how to properly price it, and that's going to be one of the key things to watch tomorrow. Okay,
very good. All right, folks, have a great day. I guess in the end, the market is still up 1125 at 1884 and whipsawing back and forth. So enjoy the rest of your day. We'll see you tomorrow at 3 p.m. Eastern Time. Thanks again.